Welcome to Module 13. Today we're going to be talking about cash flow based valuation, and this is a nice continuation of our discussion last week from Module 12, where we reviewed the dividend discount model, and the slide number 3 here is a review of that conversation. Equity investments involve two types of payoffs. So when we look at the dividend discount model, we're primarily looking at dividends and the capital gains usually associated with shareholder ownership will show up in what we anticipate as rising dividends in the future. So that model was fairly straightforward, and for a review of that I would just refer you to Module 12. This week we're going to be talking in more depth about the discounted cash flow model, which is the focus of our SMF add-in template. So if you've had a chance to work with that a little bit, download that from Blackboard and play around with the formulas inside of that model, you'll notice that that's set up to facilitate this discounted cash flow model, to calculate free cash flows to the firm in each individual year, and then to discount each one of those back to the present value. Then the sum total of those free cash flows to the firm as discounted creates what we call enterprise value, which is the value of the entire organization, independent of how that organization is financed with either debt or equity. So another way of saying that is to say that we've just calculated the enterprise value, which would include both debt and equity. If we subtract debt from that equation, we now have the equity value of the firm. And the equity value of the firm can be divided by the shares outstanding to calculate the price per share, which is what we're ultimately after when we're trying to make good decisions in the stock market, or discern a good business for a bad business, and to decide whether or not there's opportunity as compared to its current stock price. Another method that our authors go into and share a little bit is the residual operating income model. We won't go into as much depth with this model, and I will just say that this is not used in practice nearly as much either, and since it's not testable material, I'm not going to spend much time on it with this video or in class. This is one of my favorite slides from the whole class, because it summarizes everything that we've done up to this point. It summarizes the entire class. You'll notice here that at the top of the screen it gives the formula again for the dividend discount model, and looks at the discounted cash flow model and the ROPI model on slide 5 by comparison, as we track from each step in the analysis process, whereby step 1 is to understand the business environment and accounting information. So that was modules 1 and 2. Step 2 is to adjust and assess the financial information and accounting information. And that was module 3, 4, 5, 6, 7, 8, 9, and 10. So this is the meat of the semester right here. This is what we did most of the semester, is to understand the accounting and to make the necessary adjustments if relevant. 2 weeks ago we talked about forecasting financial information, which is to take everything that we've learned about the business environment and the accounting and forecast that into the future as appropriate. And then lastly, in step 4, we're applying modules 12 through 15, which are some of these valuation techniques, and we're going to again focus heavily on the discounted cash flow technique that we're talking about tonight. Learning objective number 2, describe and apply the discounted free cash flow model to value equity securities. So let's look at that model in a little bit more detail here. The basic equation lays out like this: firm value equals the present value of expected free cash flows to the firm. And to define those free cash flows, we're looking at flows from operating activities, and it's important to differentiate there that we are not taking into account financing activities, as those would be independent of how the enterprise as a whole, or the valuation of the enterprise as a whole. The most common definition of free cash flow is operating cash flow less capital expenditures. You'll also see that expressed as the the change in net operating assets, which is more precise in the definition. Operating cash flows here is different than from what shows up on the statement of cash flows. If you'll recall, the cash flow statement is laid out with net income at the top of the statement, and then various reconciliations from net income to get operating, investing, and financing cash flows. Importantly, that the statement of the operating section on the statement of cash flows will include things like interest expense that are not a component of operating cash flows. And I think that'll become more clear as we look at a specific example here. So let's focus on the formula in the center of the page. Free cash flow to the firm equals NOPAT, net operating profit after tax, minus the increase in net operating assets, which is further detailed down here at the bottom of the page, where we have earnings before interest and taxes, adjusted for non-cash revenues and expenses, less taxes in the absence of interest revenue and interest expense. So we have to compute taxes based on what they would have been in the absence of interest revenue and interest expense. So there's an interest tax shield component that we have to account for. These two terms, netted together, create the net operating profit after tax. From net operating profit after tax, we're going to subtract investments in working capital. So as our firm grows, it requires more capital to be invested in inventories and accounts receivable and so on and so forth. So we need to account for that investment. And then lastly, we need to subtract any additional investments in capital expenditures. So new property, new plant, new equipment, so on and so forth. Those two line items create the increase in net operating assets. And when we know those two things, we can throw them all into this formula to compute our free cash flow to the firm. So here are the steps we'll apply in the discounted cash flow model. Step number 1, forecast and discount free cash flows to the firm for the horizon period, and that horizon period will vary. Might be 3 years, might be 5 years, might be 10 years. The Excel file that we have on Blackboard has a 10-year horizon period associated with it, which is generally pretty consistent with a firm that has a little bit of growth in the tank. So not quite a mature firm yet, but is growing at a rate faster than the general economy. If you're analyzing a mature firm, then you may not need such a lengthy horizon period. You might be able to make the simpler, perhaps more naive assumption that this firm is going to grow at a rate that's consistent with the overall broad economy, as most mature firms do, and have a horizon period that might be as short as 3 years. Step number 2, forecast and discount the free cash flows for the horizon period called the terminal period. So after we look at the free cash flows to the firm in that 10 years, we have to make an assumption about what the free cash flows to the firm would be into perpetuity. And if you'll recall, last week in Module 12, we took a look at a simplified present value discounting technique for that terminal year, and this will be identical. Step number 3, sum the present values of the horizon and terminal periods to yield the firm enterprise value. And remember again there, that's the value of the entire enterprise, equity and debt both. Step 4, subtract the net non-operating obligations. So focus in on that keyword net there. So we're going to subtract any non-operating assets, which may include cash to the extent that it's non-operating. So take a company like Apple that has a huge cash hoard. They don't need all of that cash to operate their day-to-day business. Anything over and above what they need to operate the day-to-day business is a non-operating asset, which we would subtract from our non-operating obligation. We will also subtract any non-controlling interest from the enterprise value to yield our equity value. Now, once we have equity value, we can divide by shares outstanding to yield a stock value per share. And that's what we're after. That's what the design of that spreadsheet is set up to calculate. That's what the focus of our research report will be, is to calculate and defend that. And that will also be the focus of our in-class presentation. Okay, so let's walk through an example here. In this instance, we're looking at Procter & Gamble. We have top-line sales, we have net operating profit after tax, we have net operating assets. Each of those is calculated based on the forecast of our financials into the future, so we'll have sales and expenses, and we know how to get NOPAT, and we know how to get net operating assets. I think that's a review of Module 4, if you need a little refresher there. So now we're going to look at the increase in net operating assets, or the difference year over year. We're going to use that to calculate our free cash flows, so NOPAT minus the increase in net operating assets. So that shows up as $10 billion in 2017. We're going to discount each of these cash flows back to the present value using this present value factor, or you could use a financial calculator, or you could use an Excel spreadsheet. So we have the present value of each of those cash flows. The cumulative present value sums to $36,925,000. We're going to add that to the present value of our terminal year cash flow, which is this $11 billion. And if you recall from Module 12, we calculate the present value of that by dividing by our weighted average cost of capital less our growth rate. And our growth rate in this instance is 1%. That present value equals 241. We add that to 36 to come up with a total firm value of $278 billion. We're going to subtract our net non-operating obligations of $12 billion, and we're also going to subtract our non-controlling interest of $642 million for a firm equity value of $265 billion. Divide by shares outstanding to calculate a share price of $99.38. Compare that to the market value. If the current market value is 85, well, that represents a pretty good opportunity to buy an undervalued stock. Okay, let's revisit that weighted average cost of capital. We looked at this last week, and we noticed that our cost of debt in Procter & Gamble's case here is 1.26%. Our cost of equity at 5.27. The cost of the preferred stock is 24.57 for a weighted average cost of capital of 4.80. And one of the things that jumps out at me immediately is that the cost of the preferred stock is 24%. That's very expensive. So as an analyst, that ought to prompt you to ask some questions about that preferred stock, because it's likely paying a dividend that's very, very attractive. It may be, in this instance, that represents a superior risk-reward opportunity to even owning the stock. And you'll find this periodically out in the marketplace where maybe an illiquid issue of some preferred stock is just not trading in alignment with its underlying value, and it creates an opportunity for a talented analyst to identify that and swoop in and take advantage of a bargain in the marketplace. Some further notes here about the discounted cash flow model on slide number 23. Need to be aware of that horizon period again. I mentioned that our model takes into account 10 years, but just as easily could be 3 or 5, depending on what's appropriate. The growth rate, every individual year can have a different growth rate, but generally, by the time you get out to 10 years or beyond, most discounted cash flows models assume that that growth is stabilized to a mature economy-wide type growth rate. If you say the economy is going to grow at about 3%, then that would be a reasonable assumption. Procter & Gamble here assumed 1%, which I would just point out that's less than inflation. So over time, that's a fairly conservative estimate. The financial statement forecast, you can prepare those year by year and get very, very detailed with those forecasts. I would encourage all of you to do that. And then lastly, the terminal growth rate. What do we assume that this company is going to grow out into the future? Those become highly, highly sensitive estimates. Let's look at that sensitivity as a part of a good discounted cash flow analysis. You need to be aware, as an analyst, which are the more sensitive inputs, and spend more of your time refining those so that you have a higher degree of confidence in the growth rate, as an example. And this chart shows us here what the sensitivity analysis is for different growth rates. So 2% for the horizon period and 3% for the terminal value, with a weighted average cost of capital of 3.8, yields a present value of 128.59 per share for Procter & Gamble. You can see what various combinations of a weighted average cost of capital and growth rate yield for Procter & Gamble share price. Same story here on slide number 16, only the two variables that we're doing this analysis on are net operating profit margin and net operating asset turnover. You can see how the stock price varies with each one of those. The authors give us an alternative lens to view that sensitivity analysis through on slide number 17, where we're varying the net operating profit margin and net operating asset turnover in percentage terms rather than absolute terms. Just a different perspective. Anytime we can vary the analysis, vary the perspective, look at these numbers through a different lens, so we have a greater likelihood of observing any anomalies that might serve as an indication that we haven't gotten something just quite right in the forecasting of those financials. So just be aware of the different ways that you might look at those numbers, the different techniques that you might use to analyze those numbers. Mid-year adjustments is a minor nuance that you see sometimes. Most of these payoffs are assumed to occur at the end of the year, but that's not technically accurate. These payoffs will be accrued and realized throughout the year. So a mid-year adjustment or a mid-year assumption can rectify that. In practice, I don't see this very often. It just doesn't create that much of a difference in the analysis, whereby the majority of discounted cash flow analyses that I see bother to take this into account. But it is important to stop and recognize that these cash flows do occur throughout the year, and it's just important to know. Reverse engineering, this is a technique that I do see quite a bit and would encourage you to utilize for yourselves in your semester case projects, because it can produce those anomalies. It can identify those outliers. It can give you some real information to take into account about where you might have gone wrong or where something just doesn't make sense. And the way you go about doing that is to back into some of the more sensitive assumptions in your analysis. So you make the assumption that if Procter & Gamble is trading at $99 per share, then it's worth $99 a share. And now let's assume that you've accurately forecasted your financials into the future. You can solve for your weighted average cost of capital, or you can solve for your another variable in your forecasted financials, such as growth rate. And when you solve for those, you can compare them to, well, your peers. You can compare them to the company itself through historical analysis. And you may find that the current stock price assumes that the company's going to be growing at 20% in the future. And you say to yourself, well, there's no way that a company like Procter & Gamble is going to grow at 20% in the future, and therefore the market's crazy for putting such a high valuation on Procter & Gamble. You should sell, and get out of the way. Or alternatively, it might be underpriced, and you'd find that the current share price assumes that the company's never going to grow in the future, or going to grow at such a modest pace that it could beat that number even with modest inflation, and therefore you have an undervalued stock on your hands and an opportunity to buy. So that reverse engineering will shed some light on that discounted cash flow analysis. And then lastly, here in our summary slide, I would just point out that discounted cash flows is dependent upon that financial forecast. So put a lot of work into forecasting those financials. Go back to Module 11, look at the different techniques, make sure you have a good understanding of how that works, understand the sensitive inputs, the weighted average cost of capital, the growth rate, so on and so forth. Pay attention to your horizon period and know the major inputs that go into that. And you'll have the makings of a pretty solid model. And you can stress test that in a variety of different ways. You see a lot of analysts create expectations around a base case, and then they might simultaneously build an optimistic scenario or bull case and a pessimistic scenario, or or bear case, and weight those in a probability analysis, which we'll touch on a little bit next week. So module number 13 happens to be the shortest module of our semester in our book. So that's really all I have for tonight, and I will look forward to diving into module 14 next week. Thanks for your time.